want to say thanks to all the Cornet folks for the opportunity to share our perspective. Appreciate you all joining. I don't know that I have good news, but you can see the title of the presentation there. We believe we're kind of in for a bumpy ride here over the next 6 to 12 months. But I think also worth noting that volatility does often create opportunity, I think particularly for corporate occupiers. And so sometimes bad news, I guess, can be converted into good news and into good opportunities. Maybe that's the way to look at it. So David's going to be driving the slides. David, would you mind going to the next one, please? Okay, so there are two parts to this presentation. I'll go first. I'll cover the economic and office sector outlook for the U.S., and then I'll hand it off to David, and he's going to share some thoughts on the Chicago market. David, by the way, is based right there in Chicago. He studies that market very closely, so you kind of get the on-the-ground perspective as well. We'll probably go for maybe 40 minutes or so in terms of the presentation material, and then we'll should hopefully have some, plenty of time for Q&A at the end. We go to the next one. And you can just go one more, David. Perfect. Okay, so I guess the first point, and I'm sure you all know, the economic outlook has worsened considerably. And here you can see the bulk of the economic indicators do point to weakness. And I'll just mention a couple of these. So chart on the top left, the yield curve. There's actually different types of yield curves, but the one that is often the best predictor is what I'm showing there, the spread between the 10-year and the 2-year. So that curve has now been inverted since July 5th. And when that curve inverts for a sustained period, it has successfully predicted a recession, I believe 100% of the time. I think it's 7 for the last 7. And the curve has now been inverted solidly for 3 months. And so if history is any guide, we really can start the clock. Typically, once the curve inverts, we do fall into a recession sometime in the next 12 to 18 months. Though my sense is this one might actually come a bit sooner. All recessions are different, right? And so I'm going to talk a little bit about that here in a minute. I'll mention a couple more. Copper prices, also a very good predictor. Copper is actually used in kind of throughout the economy for home wiring to factories and industrial machinery, electronics. And because of its widespread use, it can sometimes be a crystal ball for the global economy. And you can see what's happening with copper prices. It's trending lower. It does indicate weakness is forming. Consumers are losing confidence, chart on the bottom left. Inflation's obviously still very much a problem. The latest reading on headline inflation in the U.S. was up over 8% year over year. So that's roughly four times higher than the Fed's target rate of 2%, 2.5%. Housing, chart on the far right, bottom right, is starting to get crushed by the move up in mortgage rates, which have basically doubled since the beginning of the year. And so all in all, not good. The economic data is clearly flashing plenty of warning signs. If you go to the next one, please. So odds of a recession are rising fast. It's basically sort of a coin toss at this point. The chart on the right shows that economists are pretty split on sort of precisely when the next recession will start. About 25% think it'll start sometime between now and the first half of 2023. 25% think maybe second half of next year. I think regardless of the exact timing or whether or not we even ultimately tip into a recession, economists are aligned across the board that economic growth is going to slow sharply, and there is going to be some pain that is felt. If we go to the next one. Okay, so everyone's trying to figure this out, trying to figure out sort of the contours of this slowdown. What was this ultimately going to look like? And there's lots of different scenarios, but there are really two that are emerging as the most likely. And it's scenario 1, which is that soft landing scenario on the far left, and scenario 3, which is the mild recession. So soft landing scenario That's obviously the hopeful scenario. Basically assumes nothing else will go wrong at this point. I think most importantly, it assumes that the Fed will be able to successfully slow the economy without causing a recession. So some economists are still in that camp. Our base case at Cushman Wakefield is now calling for a mild recession. We now see that as the most probable scenario. And the thinking there is that inflationary pressures are going to remain sort of stubbornly high, and more likely than not, something else will go wrong, right? That there's still, tremendous risk around the Russian-Ukraine war and what that means for oil and food supply, that there is, still supply chain risk as it relates to China's zero COVID policy or another pandemic flare-up. We're just now entering, hurricane season. We just saw the economic damage caused by Ian. There hopefully won't be more, but there likely will be others. And we just learned today that OPEC Plus will be cutting oil production, and that has implications for inflation. And so, just more likely than not, also the Fed will not successfully land this perfectly and in their attempt to quell inflation, and will likely hike rates to the point where the economy does enter a downturn. And so that's really our base case. So I would emphasize that we're in this, I'd emphasize the word mild. So the thinking there is that the downturn might not be that bad. So sort of, no recession is pleasant, but the thinking is that it'll be sort of less than a typical recession, which largely links back to the strength of the consumer going into this slowdown and the strength of the labor markets, which should help the economy, we think, be more resilient and sort of power through this a little bit better. There's other scenarios: severe recession, stagflation, many others. I won't get into those right now in the interest of time, but I would just say that those are sort of lower probability scenarios, but certainly still in the cards, right? A lot of uncertainty. We can go to the next one. And this is just showing the economic forecast behind those four scenarios. The only point really I want to make here is, unless we do get that soft landing, which again, I think increasingly seems like a long shot, what this recession ultimately means, whether it's mild or something worse, is that we're looking at likely more damage to the office sector fundamentals, right? So more vacancy is coming. Even if we just take the mild recession scenario there, would result in 1.4 million job losses. That implies roughly, 350,000 of those would be office using job losses. And if you just say, let's assume 125 square feet per worker, that works out to roughly 40 million square feet of additional vacancy, right? So I think more likely than not, we are looking at more vacancy going forward. I'll talk more about that in a second. If you go to the next one. Did want to give you one key indicator to watch, given the level of uncertainty, right? This could still go in a lot of different directions. And I think an important indicator to watch is the quit rate. So, a lot of the economic problems really do link back to inflation, and specifically to the labor markets, which are running very hot still. And so we're kind of dangerously close to entering what is called a wage price spiral. And that's where higher inflation causes workers to demand higher wages, which causes firms to in turn raise prices because they have to offset the higher labor costs. And that causes workers to go back and demand even higher wages, and sort of up and up you go with inflation. And we saw that in the 1970s. It's sort of this nasty spiral that's hard to get out of. And so, but if the Fed can bring balance back to the labor markets and get these wage pressures under control, then they will likely lighten up on interest rate hikes, which is, I think, really key to the milder scenario. And so the quit rate is really important because it's a leading indicator. It leads wage growth by 2 to 3 months. And so when the job market is humming along, people quit their jobs and they take a new job, which that job often pays more, and which is sort of part of the challenge, right? That's what's driving wages higher. You can see that the quit rate right now is at an all-time high, which is feeding that wage growth story. So we actually got some good news this week. The Bureau of Labor Statistics released their latest JOLTS data, which is job openings, labor turnover survey, JOLTS. And that did show that the number of job openings is actually falling now. It came down by about 1 million job openings. So that's actually good news from a Fed policy perspective, right? Still a lot of job openings that are out there, but it's kind of trending lower, trending in the sort of a more normal direction. But keep your eye on that quit rate. I think that's going to be really important going forward. We can go to the next one. And we can jump ahead again. So I'm going to focus on the office sector. I know David's going to talk about office as well as some of the other product types, but I'm going to keep my focus on office. Happy to share thoughts on other product types during Q&A if you'd like. But in terms of the U.S. office market, the fundamentals have gotten hit very hard by the COVID recession and the ongoing work from home dynamic. You can see from the chart, businesses shed a record amount of space. U.S. vacancy, we just finished compiling our third quarter numbers. Preliminary numbers shows that U.S. vacancy is at an all-time high now at 17.8%. For context, it was 13% before the pandemic, right? So vacancy has really shot up. And if you look at those blue bars, I mean, this isn't over. Businesses are still shedding space on net as of the most recent quarter, Q3. So you can go to the next one. And again, we see that more vacancy is coming, and I would argue that even if we don't go into recession, from this chart you can see, only 25% of leases have expired since the pandemic started, and so we still have over 75% to go. And I think the pattern couldn't be more clear. Businesses are overwhelmingly adopting some type of hybrid workplace solution, which is ultimately resulting in less demand for space. And so when these leases expire in the coming years, they are likely to create additional vacancy, right? And so I would also argue that some of this empty office space is going to get leased up over time. Right, so as job growth and business formation continue, right, sort of post-recession, that will result in buildings filling up with people. The world hasn't stopped, creating babies, and so over time we'll end up with both. We're going to end up with more people back at the office and more people working from home. But in the near term, as these leases expire, that is absolutely going to result in more vacancy. So again, very much a very occupier-friendly market here for the next couple of years at least. If we go to the next one, did want to point out that this notion that everyone is moving out of big cities, that's been highly overstated. Here are the facts. Pre-pandemic, 40 to 50% of all office leasing occurred in the gateway cities. Right, so gateway cities being New York, San Francisco, Chicago, Boston, LA, and DC. So 40-50% occurred in those cities pre-pandemic. Today, it's about the same. Right, so 44%, right in that range. Certainly, some of the lower cost markets, in the Sun Belt and the Mountain West and the Midwest, have benefited from some migration patterns. But it hasn't been en masse. There hasn't been this mass migration out of the big cities. Businesses aren't running away from the largest cities. They're still very active, still capturing roughly the same amount of leasing activity. If you go to the next one, please. Also want to just point out, kind of similar, central business districts are also, not dead. People are not running away from CBDs. CBDs accounted for 35% of all leasing that occurred before the pandemic. Today, it's at 32%, and it's climbing, right? So again, it's kind of right in the normal range. I will say that boring neighborhoods are a different story. So I'll define boring as, very few restaurant options, sort of tired-looking buildings, tired inventory, so no after-work entertainment. Those types of neighborhoods are not drawing workers back. But the vibrant neighborhoods that do offer all of that, our data shows that return to office attendance is much, much higher. We estimate 30 percentage points higher for the vibrant neighborhoods. So I want to make that point. If we go to the next one. I talked about some of the challenges facing the office sector. I also want to point out a couple of the green shoots that we're seeing, because these are important too. It's sort of confirming that, office remains very important, right? It's very relevant to workplace strategy. That really hasn't changed. And I want to highlight a couple of green shoots. So the return to office has trended higher this year. So back in January of this year, if you can remember, like the Omicron surge, only 18% of workers were at the office in any given day. Today, fast forward to today, that's now hovering around 50%. The pre-pandemic norm was really closer to 70%. I'm not sure that we're ever going to get back to that again. I do think, things have changed. But even if we sort of, 50% is the new norm, 50% of in-person, in-office attendance is the new norm, businesses will still need to accommodate for when there are more than 50% in the office on any given day, right? So I think in particular, really the peak space needs for days when the maximum number of employees are in the office for teamwork and communication, I think that's really the metric that's going to drive overall demand for office space going forward. We can go to the next one. Just another green shoot. Here we're showing that businesses are signing longer term leases again. Remember, during the pandemic, there were lots of short-term renewals, very short-term renewals, to sort of bridge to a period of more certainty. But now we're seeing that this trend towards longer-term leases. In fact, the average length of a lease in the U.S. signed this year is 74 months. So that's a little over 6 years. And that's pretty much identical to the 10-year average, right? And so I do think that's pretty encouraging. Businesses aren't in the habit of just wasting money. You wouldn't sign a lease for 6 years if you didn't think office was really important to your long-term strategy. And 6 years is just the average, right? So 41% of businesses, more than 4 out of 10 are signing leases for 10 years or more. So again, office remains very relevant. It's just changing. One more, I think. Oh yeah, another green shoot. So I just wanted to give you a sense of kind of what we're seeing around the country. And I mentioned earlier that, in the aggregate nationally, still seeing businesses shed space, but there are markets that are bucking the trend there across the country. In fact, almost 40% are actually of these markets are absorbing space again. So all of the markets in blue are recording positive absorption, meaning that on net in those markets, businesses are growing into more space. And I think what you can clearly see here is, again, it's really the Sun Belt markets, right? Atlanta, Austin, Dallas, Charlotte, some of the Florida markets sort of, leading the way in absorption. Those are cities where the return to office has been stronger, where job growth has been stronger. You can see the life sciences market, so a Boston, a Bay Area, also absorbing a healthy amount of space. Handfuls of the Midwest markets, Indianapolis, we see here, Omaha, right? Some of the lower cost markets also now absorbing. We can go to the next one. And here's really, I think, the bottom line. And I don't think this is going to surprise anyone on this call. So the flight to quality is very real, right? And in some ways, I think what's happening in the office sector, it reminds me a little bit of sort of what happened in the retail sector, maybe 10, 15 years ago, when e-commerce, began to challenge a certain percentage of the retail inventory. But it was the sort of the retail concepts that were able to reinvent themselves and that focused on experience. Those did fine, right? Those actually went on to thrive. And I think office is going down a similar path, right? Where the lower quality office buildings that really don't give tenants what they want, those buildings are dying out, right? They're becoming obsolete. And the pandemic really exposed those buildings, because if the office wasn't a good experience before, then why would you go back to it? Given that you can now work from home, that's a pretty viable option for many. But it is the higher quality office space, that does satisfy tenant demand, that does office workers something better than the home experience, fitness center, restaurants, ESG friendly, collaborative space. That space is emerging as more relevant than ever. And the data is showing that. This is showing sort of difference in rent. Pre-pandemic, there was a $9 rent spread between high quality office and low quality office. Today, that spread has jumped to $16 and it continues to grow. So again, high quality running away from low quality. With that, I think we can go to yours, David. And I'll come back at the end and I'll kind of run through some takeaway points and then we'll roll right into Q&A. So David, over to you.
Awesome, thanks, Kevin. So going to go through a few different sectors today, so office, industrial, retail, and just we'll do some high level commentary on the Chicago market in general, but please feel free to highlight anything that will be of note, or if you have any questions at the end of the presentation. So I wanted to start with sort of the current environment we're in from an office occupier perspective. Kevin mentioned that virtually all office occupiers are reassessing their footprints as a result of the pandemic. And that's happening in different ways, where this right here is basically a compilation of all of the publicly announced RTO strategies, or return to office strategies, and their footprints in Chicago. But the idea here is not every single company is the same. It's not a single industry. They all have a slightly different strategy. This really sort of spans the universe of industries and occupier types. It's less focused than a great financial crisis or the .com bust or oil bust. I think this is something that's impacting everyone, and to Kevin's point, we're seeing that play out across the office market because there is just a fundamentally different need for space moving forward. And even if the need for space will always exist, it will just be different. And we're seeing that really play out in the market in a lot of different ways. So the pandemic happens, start switching to this hybrid or remote work environment, and that has an impact on the market. So as soon as that happened, we really started to see an increase in tenants shedding space. So on the slide here on the top, you can see the increase in sublease space quarter over quarter. And as the pandemic started, we added 3.1 million square feet of inventory back to the market from a sublet perspective. And that continues to rise quarter over quarter and set new records basically on a quarterly basis, albeit the pace at which sublease space is coming back to the market is slowing a little bit, but again, still, reflective of this environment where workers or occupiers are looking to shed space or looking to reevaluate their footprint. And similar to the first slide we looked at, I wanted to add this chart on the bottom, and it's basically just saying there's a significant amount of opportunity in the sublease market, but there's not one type of tenant who's looking to shed their space. So it really spans the universe of occupiers and industries. And it's really just a different dynamic post-pandemic than it was prior. A lot of these things with technology and the ability to do Teams meetings and actually remotely properly, these were things that were sort of going to happen at some point eventually in some way, shape, or form, but the pandemic certainly exacerbated that trend. So we talked about occupiers reevaluating their footprints, giving back some space, putting some space back on the lease market, and how does that impacting our vacancy here in Chicago? So you can see obviously a huge jump from the beginning of the pandemic. So from 2020 Q1 to 2022 Q3, we're talking about 13 million square feet of new vacant space being added to market. And to Kevin's point, we're likely to see that continue to increase. Again, maybe not at such a rapid clip, but there's still some vacancy to be captured here in Chicago. And then to put in perspective, that 13 million square feet, the headquarters building that we sit in here in Chicago, that's basically the equivalent of 20 of these buildings. So it's really a significant amount of vacancy, especially with respect to where we've been historically at about 10 or 11 or 12% vacancy in our CBD. Now, Kevin mentioned the flight to quality, and I added in the Class A vacancy here as well, because you can see sort of the spread between Class A vacancy and overall vacancy starting to widen. And there's a clear outperformance of our Class A market, more so than in the past. And that is something that has started since the pandemic, and I think is going to continue to grow. On the right-hand side here, we just see major occupancies from this quarter. So these were deals that were signed maybe a year or 2 years ago, but they're actually moving into their space this quarter. And of these 13 deals, 10 of them were buildings delivered after 2018 or 2018 or after, or they were buildings where the ownership invested significant amounts of capital. So if I think about a couple of those buildings, we've got the Intro building, 500 West Madison. There was about $22 million put into that. We've got James Hardy at 303 East Wacker. Ownership put about $35 million into that. So these well-capitalized ownerships are able to invest and put that money back into their buildings and improve them to improve the leasing demand and velocity in those buildings, improve the amenities or the lobby or the build outs in general. So that flight to quality is a very real theme that we are experiencing right now, and tenants are looking for a way to lease signature space such that they can retain talent, attract talent, establish a working culture that's different from their competitors, and really just a way to sort of convince people to come back into the office. Because again, I think most individuals or most teams think that the collaborative nature of the office helps you innovate. We talked about kind of 13 of those deals going into high quality buildings. This chart here on the left is really, I think, proving that since the start of the pandemic. So we're looking at the trailing 4 quarters of leasing activity starting at 2020 Q1. So that this really kind of takes into account the full 4 quarters of leasing activity prior to the pandemic. And as you can see, obviously leasing activity dropped off a cliff to start the pandemic, but we really started to see a sustained outperformance of our trophy and Class A buildings relative to the rest of the market. And the trophy market, in fact, surpassed pre-pandemic levels a few quarters ago. So this is really a sustained theme and something that I think will continue, especially as occupiers to differentiate themselves, and some of the more functionally obsolete buildings become less of an option for many of those occupiers. On the right-hand side, you can just see how that trophy leasing has shaken out over the last couple of years. We're talking about something that was 15% of annual activity in 2019, so before the pandemic, and well over a fifth or just over a fifth of the activity year to date. So again, just significant emphasis on very high quality buildings. In Chicago, of course, a trophy building would be like BMO Tower, the tall high-rise buildings that just delivered, but a lot of the new construction in the market, there's some construction in River North. A lot of the riverfront properties are very highly coveted. So those types of assets are attracting a large share of the activity. And then at the bottom right, here's some deals. So we're really seeing, and Kevin mentioned it was a tenant favorable market. We're really seeing landlords aggressively negotiate with tenants to sort of attract them to their space. That's another part of the equation, is that prior to the pandemic, the TI that was being offered to tenants were roughly 14% lower, and the free rent was certainly lower as well. So landlords are starting to come out of pocket to sort of attract that level of occupancy that will be accretive to their asset. So what is, we saw the outperformance of Class A and trophy assets. What does that mean current? What does that mean for the outlook? So this chart, we're looking at Q3 year-to-date total leasing by year. So through 2022, we've got all of our historical leasing, and then 2023 forward is our projected expirations for those Q3 year-to-date periods. Of course, we're well below where we were prior to the pandemic. A big chunk of that leasing activity and increasingly so has been going into a smaller segment of the market or trophy or Class A buildings. There is certainly, I think less expirations or relatively healthy expirations over the next few years. But as we know, with tenants looking to downsize and reevaluate their footprints, those expirations probably are a little overstated. So what we're talking about in terms of outlook, is a smaller pie, and that pie also is focused on a smaller segment of the market. So it's an interesting nuance, but certainly some more, I think, struggles for the office market broadly speaking, but mostly with some of those functionally obsolete buildings in that bottom of the market that will certainly languish. What's really interesting though is that this is of course completely at odds with the industrial market. So in Chicago, the Chicago industrial market is by far the biggest in the U.S. Centrally located, benefits from multimodal transit, the airport access, very well located, well positioned. You can see here that historical vacancy is basically at an all-time low, and has been trending that way for several years. Even prior to the pandemic, we were moving in a direction of e-commerce and online shopping and grocery delivery, and away from some of the brick and mortar concepts. And the pandemic really exacerbated those trends by forcing people to utilize those things who weren't already utilizing those services. So that created a need for last mile distribution, e-commerce, and frankly, at which point in time, there wasn't really that much inventory available anyways. Prior to the pandemic, we're talking about vacancies that were just a few percentage points higher. So that really led to a lot of new construction and really just a considerable amount of demand for industrial product in our market. And also too, and dissimilar to the office market, a lot of these deals, a lot of this activity is coming from out of market. So, something that might not show up in the future expirations is new activity from outside of market occupiers looking to expand their operations in our region. So we're really seeing a ton of activity, and that activity is also then driving new construction, which is coming harder and harder to find relevant land sites to build or to convert into production. But we're really still seeing on an annual basis increased construction, whether it's built to suit or speculative, really just a significant amount of development. You can see in 2022, we've got about 14 million square feet of speculative construction underway. Speculative, of course, meaning you're building, investing, and delivering on the building without a tenant in the pocket. So it's more of a risky play from the developer's perspective, but demand is so strong that developers are totally comfortable with delivering a building without having a tenant in their pocket, which I think just goes to show how strong this market is, and sort of dissimilar from the office market. Very, very few developers would break ground on a building right now without significant pre-leasing. So just a very interesting dynamic and difference there. It's very similar to the office market. I put together this slide here. You can see historical leasing is really robust, especially the last few years. We've had record leasing 2021, the second highest level of leasing to date in 2022. And of course, our aspirations look, I think, relatively low, but this doesn't account necessarily for the expansions that will take because of the really strong industrial market. And again, the new to market tenants that will be coming to the market to be centrally located in this multimodal hub here in Chicago. So really a robust outlook for the industrial market, albeit potentially slightly slower, just given economic concerns. And I think just a general slowdown in the market. I was talking to a broker, and they mentioned that they would receive proposals on their buildings, several before they would even become available or before they would even break ground, and they're still receiving a record level number of proposals on those spaces. It's just come down a little bit. So the market is still incredibly strong, but certainly has some headwinds with just the general economy, the cost of construction, a labor shortage, which makes it challenging for these large industrial users to attract talent. But again, the Chicago market, industrial market in particular, is well positioned for growth. On the retail side, one of the great things we've seen significant retail market improvements since the start of the pandemic. There were certainly some declines at the outset, but retail sales have really come back in a big way. A lot of that's just driven by strong demographic trends here in Chicago, and then just simply the market just recovering in its own right. But some of the major contributors to this retail sales growth, we're talking about apparel, food and beverage, vehicles. A lot of those have recovered or have recovered more so than where they were prior to the pandemic, and that's, I think, that is exemplified in this slide here, where we're seeing on the left-hand side really an increase in visitors in many of the retail assets across our region. So the red represents on the left-hand side here outdoor malls, and we can see that the outdoor malls have seen significant increase in foot traffic, and then also combined with just a lack of new supply over the last 10 years, and the demand for retail coming back, we've seen really strong rent growth at the same time. So there are certainly some segments of the retail market that are suffering. Of course, retail that's fine on the office market in the Central Loop. I know LaSalle Street retailers have had some troubles, but in well-positioned retail assets in the like Kevin mentioned, the non-boring markets, those are doing very well, and retail is actually sort of the best kept secret right now in the commercial real estate market. So just a mixed bag in terms of the performance of these sectors, just really dependent on the asset positioning for office and retail. And then on the industrial side, things are extremely robust, but just slightly slower than it was in the past year. Kevin, I don't know if you wanted to take this.
Great, David. I learned a lot there from that presentation. It actually made me feel a little better about things. So I'm actually going to skip this. I think this I'm sure that Sheila and Cornette will circulate the slide deck, and you can, if you want, you can spend more time with it. Those are just a summary of some takeaway points from coming at it from an occupier perspective. I want to roll right into Q&A since we have about 10-15 minutes left, and I saw some good questions come in. David, can you go to the next slide? I think that is the last one. Oh yeah, okay, good. So first question, let me sort through that. Okay, so first question is, when will the hybrid model and the need to build culture converge? And then there's more to this question. Have we actually seen if there is a true bottom line impact to the business to know that office space shedding will still be, strong long term? Do you think this will ever swing back due to the need to foster and build culture within an organization? So really good. That's the essence of the question, which is a good one. I'll take a stab, and then David, feel free to share your perspective if it's any different, if you have anything you want to add to it. But I think my response to that is we're still learning. I think we're all still learning a lot about the future of office. Hybrid is a new experiment, right, for many companies, and many are just starting now to kind of think about it. And fostering culture is not easy to do in that new environment, right? I mean, traditional office space where we're all sitting together all of the time, virtually every single day, that was already a lot easier in terms of, right, from a cultural perspective, from a company culture perspective, right? A hybrid environment, it doesn't always feel like you're on the same team, right? If we're sort of scattered. And so my sense is that there will be some swing back, to more in person in the office. And I think in particular, who's going to drive that, interestingly enough, are going to be the young people, the younger generation, probably people like David, who, because our surveys show kind of overwhelmingly that, younger millennials, Gen Z, generally prefer to be in the office. They feel like they're not so much, that they feel disconnected from the company culture, and it's very difficult to sort of prove yourself when you're working remotely. And so I do think that there's going to be at least some swing back, but I also think flexibility is king. And I think it makes too much economic sense. I think bosses and managers and CFOs prefer it because there's a cost savings aspect to it. And I think in general, workers like the flexibility, right? They want to be in the office, but they also want the option of working remotely when they need to. So I think we're going to see a lot of different models emerge as businesses figure this out. How do we balance productivity, culture, employee satisfaction? I think you're going to see a lot of evolution of office space as businesses figure that out. That's sort of my take on it, David. I don't know if you have anything, a different read on that, or anything you want to add.
Oh no, I totally agree. I think some of the survey data that we had been collecting originally, showed some of the ideas behind, why someone maybe wouldn't want to come to the office or why they would want to work remotely. A lot of it was like the flexibility, and I think some of the data we're seeing now is more tied to the issue with the commute. So I think we're starting to see a lot of office occupiers make types of moves that I think will have a beneficial impact on the commute. For instance, Google just relocated or are planning to relocate from Fulton Market, which is our top tier market, to the Thompson Center, to sort of, I think, battle that issue with the commute, but at the same time, create an environment that is easy for your employees to get to and collaborate. But I think that this environment, like Kevin said, makes too much sense from a bottom line perspective, and I think is here to stay in some respect, but it will evolve.
Yeah, good point on the commuting patterns, and that's definitely a major part of the equation. Okay, here's another one. How will construction costs impact both development and leasing activity across the office and industrial sectors? So how about David, you want to take the first crack at that?
Yeah, I think in terms of leasing, there's just more lead time involved in building out your space and getting all of the materials. So it puts a damper on leasing in terms of the time it takes to get a deal done from start to finish. I also think occupiers might avoid taking new space or building out signature space if that cost is something that's too much for them to take on. So I think it will have a dampening impact on leasing activity from an office perspective. I'm not sure many developers are gonna develop office right now at the moment. And on the industrial side, I think that construction will continue to happen. It's just a matter of the financials involved in the deal. How much did they get the land site for? Do the numbers make sense? But I certainly think construction pricing will have a dampening impact on both construction and leasing, but perhaps not to an extreme extent.
Yeah. The only thing I would add, agreed. I think for office, I guess I come at this from a little bit of a different way of thinking about it. So I think you said basically the development pipeline is likely to slow, and I completely agree with that. I think most developers do borrow money to build, and the cost of borrowing has shot up. And I mean, we haven't had construction loan rates, mortgage rates this high in 25 years. And so lenders aren't exactly thrilled, you made this point, to offer that debt given the economic uncertainty. So the construction on office, I think, is going to slow fast. And one way to think about that for corporate occupiers is, I think that's going to place an even greater premium on existing high quality space, right? Because you don't have the wave of supply. There's what's under in the works is going to get finished, but then it's going to stop. I think it's going to slow fast, and so I think it's going to be very competitive actually for that higher quality product that seemingly an overwhelmingly number of tenants and occupiers really want. So I think that's just something to keep in mind. I got another one here, David, which I think, so this is my strategy. I'm just going to give you the question and it gives me time to actually form an answer. But here's one. What property sector is most significantly impacted by the current labor shortage issues, and how long do we expect these conditions, I guess the labor shortage conditions, to persist? Any thoughts on that?
That's really tough because the way that I think about it is impacting every sector in a significant way.
Yeah.
I would, if I'm just gonna jump in and choose a sector, I guess my choice would be industrial, just because there's so much demand for industrial space, and there's opportunity for occupiers to expand and increase their footprints, but the amount of labor does not scaling or increasing with the amount of demand for that space. I think in the near term, just based on the current environment, the labor shortage probably impacts the industrial market a little bit more, but it's certainly impacting every sector in some way.
Yeah, I agree. Hitting every sector, agree with what you said there. I'll take maybe the second part of that question. How long will these labor shortages persist? And I think my short answer to that is longer. There are some signs that the labor markets are sort of loosening up. Labor force participation has been gradually trending higher. It's still well below pre-pandemic levels, but trending higher. I think I saw there's an additional 800,000 more people that entered the workforce last month. So that's some good news. The number of people that are not working due to the coronavirus, either they're sick or they're caring for people who are sick, or they fear getting other people sick. So that overall number that's stayed out of the workforce is starting to trend lower. So they are starting to enter back into the workforce. So there's some sign. I think inflation actually is a kind of a motivator. If you think about, there's a one income household, maybe there's a need for a two income household to sort of help support the family through this higher inflation environment. So I think there's some forces that are helping the labor shortages challenge, but I also think what happened was the baby boomer generation sort of exited, a large portion exited the workforce. They retired early and they're not coming back. And I think the economy is going to be sort of dealing with that for quite some time. So I think that lack of labor supply is going to be a challenge for quite some time, at least next couple of years. Okay, we only have a couple minutes left, David, and I always like to end webinars with my own question, because I always feel like I depress everyone. And I like to end on something positive. And so let's do that. David, I'm going to ask you to tell me something good. What makes you optimistic about the future?
Yeah, so I think for Chicago and Illinois in general, I would say demographic strength one. I think there were some preliminary estimates that state or the city were actually losing population, but that's actually not the case. So I think demographic strength, continued population growth, albeit potentially slow. I think that's a positive. Mm-hmm. And then two other things. One, Chicago has the most diversified economy of all large U.S. markets, and I think that plays well with talking about economic uncertainty that may not have more impact on certain sectors and industries. And then the last thing that I'm really excited about, I think, is more tied to sort of the sense of an innovative economy. I think you mentioned earlier, it was mentioned earlier that you guys go visit, I think, Lincoln Yard. So we've got Lincoln Yards, Fulton Market, the Discovery Partners Institute on the 78th that's supposed to break ground in 2024. But I think the opportunity for life science to really expand and take off in this market is exceptional. And that with it will drive a significant amount of growth. And we're seeing that a lot in the venture capital numbers already. last year, the amount of venture capital invested into Chicago companies doubled, and so too did the number of venture capital unicorns. So I think there are certainly some bright spots around the innovative economy, how diversified our economy is, but also just general demographic strength in our market.
Strong answer. You give me three reasons to be optimistic. I'll do one. So for me, I'm optimistic largely due to the strength of the U.S. consumer. And I think going into this slowdown, we know that household balance sheets are in excellent shape. Debt service ratios are very low, so people largely can make their monthly payments and still have money left over to spend. There's still a lot of excess savings, right? So if people keep spending at a reasonably healthy rate, this may not feel like a recession really at all. So there is a sort of a positive script there. Business profits are very high right now. Those could hold up. Labor markets could hold up. I'm extremely encouraged by some of the trends that we're observing in the entrepreneurship data, which was just going gangbusters before this slowdown, right? So lots of applications to start your own business, which I think on the other side of this means lots of good things, lots of jobs, lots more wealth, more products for all of us to enjoy. And I am just always in awe of the U.S. economy's ability to sort of bounce back, and usually pretty quickly. And I have no doubt that it will bounce back again. So that's my optimistic view. I think we're at time. Again, I really appreciate you all joining. Hopefully you found this helpful.